There are 12 principles of accounting that I want to go through with you right now because these underlie all the accounting policies and how transactions are recorded. Now, singly, they may make sense, but collectively, it will feel a bit overwhelming. And furthermore, you'll see that in certain circumstances, they may even contradict each other or not be covered or used in its entirety. So I have to have this huge caveat when I talk about GAAP and the actual principles. But we'll see that accounting is tricky partly because we try to set simple overall rules when the real life circumstances are not always that simple. So we have a standard, and we'll adhere to this most of the time, but we reserve the right to have exceptions or even contradictory positions from time to time when the circumstances warrant it. And that is what makes accounting tricky. There are many things that make accounting tricky, but one of the main areas is that we have rules that seem to shift a bit on us. So we're going to go through this so that you can understand the basic rules and then some of those exceptions, because it will take you a CPA certificate to understand all the nuances of all the different transactions that you may encounter in the recording of transactions for a company. So let's jump right into the first of the 12, and that is the accrual basis. And this means that we record transactions as they occur, which is not necessarily when cash moves. So you and I work on a cash basis. When we get money, we have revenue. When we don't get money, we have no revenue. But it's not that simple for a company because let's say that there's some plumbing that's done for a company. The plumber came in, they did their work, but they haven't gotten back to their office yet to bill us. So the question is, do we owe them money? Is there an expense we just incurred? The answer is yes, because even though we haven't been billed or paid for the services, we have actually incurred a liability and we owe the plumber money. So that economic and legal characteristic of that transaction makes it that is something we record, and that is called the accrual basis of accounting. Not cash basis, where we do everything based on cash moving, but accrual basis, where we look underneath more at the economics and the legal aspects of what just happened. The second one is conservatism. This is not politics. This is conservatism, which means we really want to make sure we don't overstate assets or overstate income. So what that means is that there's a slight bias in many of the rules where we'll be a little tougher when we recognize expenses than when we recognize revenue. And that's because of this principle of conservatism. And an example of that is we sell a product with a warranty. Let's say it's a 1-year warranty, parts and labor. Well, when we sell that product, and if you were asked, will every one of those products be perfect and never need repair? The answer is no. That's why you have a warranty. So should the product be dead on arrival and need repair or replacement, send it back. We'll make good on that product for you. When the sale occurs, you know some will come back for repair. And under the principle of conservatism, when you sell a product, we must estimate the amount of repairs and warranty expenses we may incur because we had those sales. And that is an example of the warranty reserve and how conservatism has us anticipate that we will have expenses, we will have things we have to fix in the future, but we record it now. So we show liability now, even though it's working fine. Third is consistency. This just means we don't flip-flop, that our policies and procedures stay put within the company. Different people in the company do the same ways, same policies, and between periods of time, from year to year, quarter to quarter, we just can't change policies to fit our whim. Now, you know that there's a temptation to change the rules to make you look better by looking at the income statement and boosting it up when we're having a weak year, or maybe sandbagging and tampering it down a bit when we're having a very strong year. That's not accounting. Accounting is supposed to be within a set of guidelines so that we can know that there's a consistency of how the accounting is done. The fourth is cost. Cost is how we record a transaction. When I buy a piece of equipment, we record it at the cost. Well, that's easy. It cost me $10,000 because it's worth $10,000. But it is a little bit trickier if you go longer term. And an example of that is when we buy real estate. Let's say you bought an office building in a downtown area, say 50 years ago. Well, when you bought it, of course, put it in at cost. It cost you $1 million. That's easy. But over those 50 ensuing years, the value of that real estate may have gone up 100-fold. Well, that's great. Why wouldn't we show that land and building being worth 100 times what we paid for it? The answer is that is somewhat subjective because you haven't sold it. And it also is tempting to manipulate. So for various reasons, we want to stay away from this ambiguity or perhaps manipulation of the valuation of an asset that's quite important, like your headquarters building. And so therefore we say, even though it seems arbitrary and way too conservative, we will use historical cost to capture the cost of land and buildings. So that is one distortion that almost every financial statement has, is that there are assets that were bought years ago that are worth more money today, but the balance sheet doesn't show it. The balance sheet will reflect the historical cost of acquiring that asset in the first place. So the next one is economic entity. This just means, who are you doing the accounting for? Is it a company? Is it a partnership? Is it a foundation? Is it the government? Or is it your personal financial statement? So we have to define what is the entity that we're doing reporting on. Next is full disclosure, that we can't just selectively tell certain things like the good news, but not tell the bad news. An example is that if you've been sued by a person that was claiming to be injured on your property, even though you haven't gone through a legal process, when it gets to a point where it's probable that you're going to have some liability there, and you have a way to estimate what that might be, you're then required under the disclosure requirement to tell people about it. And if it's a small slip and fall in your store, that's no big deal. But what if it's a major patent infringement lawsuit between you and another major competitor? That could be in the hundreds of millions of dollars. So full disclosure covers that we can't just selectively pick what we want to show and what we don't want to show. We need to require of relevant and material information for our users, particularly investors. Next is going concern. This just means that the company is going to stay around. An example, again, let's say that's the equipment we're talking about, that's worth $10,000. If your business was going to start and end in 1 year, and you bought a $10,000 piece of equipment, well, you're going to have to expense that $10,000 in year one because you're using it up. The business is closed down. So therefore, your expense for that equipment is $10,000. But let's say it's something more typical. Let's say you're going to be around indefinitely, 5, 10, 50, hopefully 100 years from now. Therefore, now you have the same equipment worth $10,000. And you say, okay, how long will this last us? Well, you can say, well, let's say the equipment is a truck. That truck will last us 5 years easily. So why don't we spread the cost of that truck over the 5 years in which we use the truck? Let's say it's a $100,000 truck. Divided by 5 is $20,000 a year. So each year for the next 5 years, we will expense $20,000 for this high capability industrial truck, right? So that is why depreciation, which is what I just described, spreads the cost over the useful life of an asset. And that is made possible or reflects that the company is a going concern. It's going to be around a while and more than 1 year. Next is matching. And this is an easy one. It says that when you recognize revenue, you better recognize the expenses that go along with it. So the absurd example is, let's say you had a Tesla dealership and you just got a shipment in this morning of 5 Teslas, and there's such a demand for the car that you call your waiting list. 5 people come in, they all pay you immediately, they all drive off your lot with the Tesla. And you say, I sold these Teslas, but I don't have the bill yet. I don't know what they cost me precisely. I know roughly, but I know exactly what those 5 will cost me. What we're required to do under matching is, of course, record the revenue because you sold the cars, but you must either get the cost of those cars so that you could expense it and show a liability to Tesla for those cars, or if they don't give you that estimate or that invoice, you must estimate it and then record it anyway so that your income statement would show both the revenue and the expense of selling those cars. Otherwise, your income statement would be wildly distorted, showing revenue as and no cost, right? That'd be ludicrous. So matching is a simple one. Match revenue with the expenses. Next is monetary unit. Okay, we're measuring in US dollars in the US. And if we have some things that are not quantifiable, then we don't disclose it. We may disclose it in a note or additional information, but it's not recorded on the statements. What if you're in multiple countries? You're in the US where we use dollars, but you're in Japan, you use yen. You're in China, you use yuan, you use the euro in Europe. What then? Well, then we will then convert the income statement and balance sheet items to US dollars so that we can consolidate and present a set of consolidated income statements that are all in US dollars, right? Makes sense. Otherwise, it'd be a nightmare trying to tear apart how a multinational derives its revenues. Next is reliability. This means that we're responsible for providing accurate and relevant information that has an audit trail to it, that we don't make numbers up, that if it's an estimate, we document how we made the estimate. So it could be assessed later on if you're reasonable in how you did your analysis and estimation. Every single entry must have some support. It could be something like an invoice from a vendor. That's an easy one. Or it could be an estimate of interest expense on a bank. That's a pretty easy one because you know how much you borrowed, you know the interest rate. Sometimes it's harder, like that example of warranty. How do you know what the expected warranty repairs will be on that product? Well, you can look at the history of the product and see how reliable has it been and what has it cost you to repair in the past. So we make an estimate in those cases. What if you've never sold that product? Well, now you're really out there making an estimate, right? But you must make a good faith effort to estimate, in this case, the warranty obligations. So revenue recognition is one of the most important principles, and it is, FYI, one of the most abused principles because everyone wants to record revenue. There's a temptation to try to record revenues early, and therein lies the conflict. To look good to your banker and to your shareholders, you want to show a lot of revenue. But what if we haven't quite done every single thing that has us deserve to count the revenue? Well, under GAAP, you should not record it then. What we look at is this idea of an earnings process. And the point in time, from a technical wording standpoint, is when the performance obligation is met, then you can record the revenue. An example is Amazon. People go on Amazon all the time, every minute, and they put things in the shopping cart, and they click buy it now. I guess buy it now is eBay, but they click checkout, and they buy the product from Amazon. Well, Amazon then has an order, but they haven't done the work yet to earn it. You ordered a book from Amazon. If they have it still in their warehouse, they haven't earned it yet. So when do they earn it? So they set a policy on what is the revenue recognition event. And for most companies, and like Amazon, when they hand the box that contains your book to the mail service, FedEx, UPS, whoever, at that moment they give to that third party, they say, okay, I can count the revenue. So that is their policy, that when I hand a box to a third party carrier, then I recognize revenue. Okay, that's easy. But it's not always that easy for companies. So this is one of the most important and, as mentioned, one of the most abused, if you will, by people who are getting a little bit too loose with their numbers. Next is time period. We measure based on regular time intervals. Could be a month, could be a quarter, could be a year. Internally, most companies run financial statements once a month. They don't publish it to the outside world once a month, but they run it so they can manage their business well. Public companies must report quarterly summary information to their shareholders and the public, to the SEC. But it's just, like I said, a summary. It's not a full set of audited financial statements. Then once a year, they do have to report full financial statements and full disclosures, and they're audited. So that's why time period is important. It gives us a reliable sequence or pattern of when we could expect to get information to see how the company's doing.